might be a GDP-sensitive type asset, we've converted it very much to counterparty risk. So that's where the uncorrelated nature of the portfolio comes from. Even if 30% of the portfolio is technically GDP, a lot of those assets really don't have GDP risk. Most of them are actually contracted. That's one more reason why we wouldn't own a toll road. I can't contract with anyone on this call to drive on a toll road. So in times of economic stress, people will actually avoid having to pay the toll, for example. So that might be in a more high-risk strategy than what we have.
Chris, maybe just sticking on this page for a second. If you think about the three examples that you gave, Southwest Water, Southwest Generation, and Newport Aviation, what are some of the returns that we're seeing, maybe let's say over the past year, in those respective categories?
Yeah, so it's a good question. On the regulated assets, typically your return is based on interest rates. So wherever the interest rates are today for the past 20 years, we've seen about a 7% premium to rates. That's very much what we expect going forward. So as rates begin to rise, that's actually positive for this portfolio, as the regulator will look at where rates are and typically give us that premium. So we're looking at a 10 or 11% return in regulated assets. Contracted power, the return is made up of almost solely yield. So right now we're looking at 8 to 9% returns in renewables assets where, again, if it's 9%, that will be all 100% yield. You won't see any capital appreciation in those assets. Finally, GDP sensitive. Some of the airports are going to be higher risk, higher return. So the airports we own in Australia is about a 16% return since inception. The yield might be closer to 4%. So again, more capital appreciation in those assets. But I think our focus is more on the regulated and contracted assets that really provide that visible and stable cash flow. The next page has a specific example, and we talked about Southwest Water Company. So I won't go into too much detail, but again, this is where we took a listed water company private. We created Southwest Water Company and started buying probably 1 to 2 water utilities a year. So we're getting synergies from costs. We can refinance these businesses. And again, it looks like one board, one management team, but at the end of the day, it might be 5 utilities in many states across the U.S. And for us, we're very much focused on the southern belt of the U.S. at the moment. It's just where we think we have the most transparency in terms of regulators, cash flows, and we typically know exactly what we're going to get out of those regulated assets. Page 13 on the left side of the page has the breakdown of all 18 companies as a percentage of the overall portfolio. So on the bottom left, you would see Nortegas as the largest single asset in the fund. That's 7.6% of the fund. Synetics is somewhere in the middle in purple. You'd see it as 13%. That's one company, but it's about 200 underlying solar farms. So again, we don't necessarily consider that single asset risk. There are many counterparties with contracts that work through just Synetics. So for us, avoiding concentration risk is extremely important. We've absolutely had some underperforming assets, and it's not to say that that won't happen in the future, but for us, again, avoiding single asset concentration risk is really important. And as we grow, we're a $10 billion fund today. There's no target to get to $20 or $25 billion. The goal is really no single company greater than 5% of the overall portfolio. So that's very much our views on how we should grow going forward, but right now we think we're one of the most diversified funds in the industry at the moment. Page 14, for us, probably the most important page in the book when you're considering what makes core infrastructure, and Peter hinted on that a little bit earlier. On the left side of this page, the 2019 bar, the gray and the blue make up the percent of the portfolio that's either contracted or regulated. Again, that's where we have the most visibility into the cash flow. 84% this year, contracted and regulated. Anything in that sort of olive green is you walking through our airport in Australia and parking, buying coffee, buying dinner, things we can't necessarily contract you to do. Now, this page shows if we did absolutely nothing to the portfolio. So in a worst case scenario where we didn't buy, sell, or recontract anything, on the right side of the page, the 2028 bar, the gray and the blue still make up about 2/3 of the portfolio being contracted or regulated 10 years from now. So when we talk about visibility into cash flow and our expectation for that yield being about 7%, this is exactly why. Is because we have forecastability, we have visibility into the contracts and regulated natures of most of these assets. And again, that's why we think cash yield being 7% going forward is fair. And for us, the 5-year volatility on that cash yield is about 1%. So again, our goal is low volatility, stable cash yield, somewhere in the high single digits. I think that's exactly what you should expect out of this portfolio. Turning one page forward to page 15, these are the returns since over the last 10 years. So if you look at the 1-year numbers going down, 10.4 gross, 8.4 net, and 8.2 in the form of cash. You can see the USD return in there as well. Obviously, there is a foreign exchange impact. It is obviously a global fund. If you look at the 10-year number going right to left, you'd see a positive trend in gross performance, net performance, and cash yield. So for us, that's the fund diversifying. That's a lot of lessons learned to the point where we hold the portfolio at a 10.3% discount rate. Now, what that means is on a quarterly basis, KPMG, Deloitte, and E&Y will value all the assets in the fund. They essentially give us a discount rate for the overall fund, which today is 10.3%. That is the expected gross return of the fund based on their underwriting. So again, after fees, taxes, and expense, that gets you to about an 8.5% return. That's exactly where we are today, and that's somewhat where we expect to be going forward. When we think about currency, typically, if investors are taking a long-term view, which is 5 or so years, we think currencies tend to mean revert. I would expect the U.S. dollar to depreciate going forward, which would obviously be positive for U.S. dollar investors. It's been a pretty volatile last 10 years in terms of currency, but again, I think over the long term they tend to mean revert, and that's exactly what we should expect for U.S. dollar investors. We have key terms on page 16. So again, this is obviously through iCapital, so management fee and the 25 basis point charge is obviously embedded.
And just so it's clear for United Capital, it is 50, so it's 1% underlying management fee and 50 basis point iCapital access fee.
Got it. Okay, so 50 basis points on top for iCapital. When you look at the incentive fee, this is only measured over a 3-year period, so no one would pay an incentive fee for 3 years. We take 15% of any net return above 7 and below 13.5. Now, the reason it's capped at 13.5 is because we shouldn't be trying to get a 20% return in a core fund, so we don't take credit in the incentive fee for that. And then there's also no catch-up. So, for example, if we received a 10% return, we would only take 15% of the difference between 7 and 10. We would not take 15% of the full 10%. So that ends up being a pretty big impact when you think about the incentive fee having no catch-up versus having a full catch-up. Finally, when you look at reporting, which I think, obviously it's going to be a little bit different from a mutual fund or anything like that, where reporting typically happens 30 business days after quarter end. So KPMG, Deloitte, E&Y will need to do their valuations. That's when we come out with specific investor statement, snapshot performance, and then quarterly returns, our quarterly report. Our annual report, for example, just came out in April, which includes information on every single asset, ESG, performance, and our market outlook as well. So overall, looking at page 17, I think what you should expect out of this fund is a pretty quick 6-month access to a fully diversified infrastructure portfolio that's delivering at the moment about a 7% yield with very low volatility. This isn't going to be your 15 to 20% return, but I think low volatility, high single digits, that's exactly what you should expect, where again, your clients have the ability to take that income quarterly.
Maybe with that, we can open it up to questions to start. I have a couple, and Melissa has a couple as well. It seems like there's a couple that have started to come in online.
That's right. So maybe we'll start from the top here. So I got this first question, and Chris, I think you touched on it a little bit, but talking about how this fund fits in the portfolio, you mentioned that it may be a fixed income replacement, but would you elaborate on that a bit in terms of portfolio construction here?
Yeah, I think obviously investors look at this differently, but our expectation of about an 8% return, again, with most of it coming in the form of cash. Many will use this with fixed income yields just frankly being a little bit lower than usual. You're taking similar risk in this fund while still getting a 7% or so yield. And when you look at the worst year in terms of local currency performance in this fund, that was 2009. We were down about 4%. We still paid off a 3% yield. In that same year, equities were down about 40%, fixed income was down about 6%. So similar volatility to fixed income, but at the same time you're getting a higher yield, and that's where I think that this is the time where investors are looking for alternatives to deliver that.
Great. So the next question we hear is about the return specifically in 17 and 18. I think you just addressed this a bit, but why are the returns in 17 and 18 so much higher than 2011 to 2016? And talk about a little bit about the cash yield during that period.
Yeah, sure. That's a great question. And I think it goes down to a couple things. One, sort of the biggest risk when you start an open-end fund is the very beginning. So the first few years, if you think about it, your first asset is 100% of your fund. So we had that and then walked 1 year later into the financial crisis. So it wasn't the best timing on our end, and I think that since then it's been making up the performance, lessons learned, slowly diversifying, and soon we'll probably be divesting a few assets that we think are underperformers. But really what you're seeing is underperformers historically that have turned around. That might mean longer contracts in renewables, longer contracts in natural gas, improving a board, improving a management team, buying out partners. We've done a lot of things over the past 5 or 6 years that have improved performance. It all started with a portfolio manager and CIO change in 2013, so about 6 years ago. And I think that's where we focused on platforms. That's where we focused on governance positions that we didn't before, and you've seen a material improvement in that total return. I think if you looked at this fund 5 or 6 years ago, you wouldn't want to buy it. Frankly, we were at about $2.8 billion in net asset value, and we were not moving. And it wasn't until that CIO and portfolio management changed that we slowly started to see performance improving. The portfolio started growing and diversifying to where we are today, which I think, again, is one of the more stable, diversified portfolios out there. Again, your investors aren't buying the portfolio 6 or 7 years ago. They're really buying what we have today.
Chris, on that note of kind of the new portfolio manager and the new CIO coming in 2013, maybe just briefly talk about the team. How's the team structured? What do they focus on? Where are they situated?
Yeah, absolutely. So there is a team page, page 19. The team right now is about 50 people. They are solely dedicated to this one fund. I think this is important. When you see other managers out there, they might have an open-end fund, closed-end fund, different risk spectrums. For us, we have this one fund. 50 people are focused on it. Again, they're split across New York and London. I think the important piece for us are the independent directors. So when you think about any company that we own today, again, because we're taking a control position, again, and we just reached the team page. So you have these 50 people. You might have 1 or 2 max sitting on the boards of the companies, and you have 4 to 5 what we call independent directors sitting on every company. So when you think about the airports in Australia, the former CFO of Qantas, one of the largest Australian airlines, sits on the board on our behalf. So again, we'll have 4 or 5 of those on each board, which obviously improves governance, and I think that has been a key driver of improved performance. We did not do that until 2013. I think that was a key focus when the new portfolio manager